This is VERSED, powered by VIUM Capital, the podcast that brings you conversations with the leaders driving change in seniors housing and healthcare. I'm your host, Steve Kennedy, and together we'll explore the insights, challenges, and solutions shaping our industry.
Well, welcome to this most recent edition of the VERSED podcast, powered by VIUM Capital. I'm really excited about this one in particular. We have leadership from Gardant Management Solutions, the largest affordable assisted living operator in the country, and a group I've worked with for about 2 decades. And so chairman and co-founder Rod Burkett and co-CEO Julie Simpkins. Rod and Julie, thank you for joining the VERSED podcast.
We're excited to be here. First one in 2026 too.
Appreciate the opportunity, Steve.
Well, first of all, before we get into, affordable assisted living, just for the audience that may not be as familiar with Gardant, maybe Rod, if you don't mind, just give a little bit of an overview about Gardant Management Solutions and the scope of services that Gardant provides.
Yeah, I'd be happy to, Steve. I co-founded Gardant back in 1999 with a business partner. It was in reaction to Illinois passing the piece of legislation that created the Medicaid waiver program in Illinois for elderly waiver assisted living. And our whole purpose for creating the company was to increase accessibility and affordability in assisted living. Back in those days, we had 2 licenses with partners to develop, and we're lucky enough to partner up with a lot of different developers and created a good pipeline over about the next 15 years. And Gardant, for its first 20 years of its history, was mostly involved with new development. But in the last 5 years, it has grown to be a lot of management acquisition. So the portfolio is kind of around 100 properties under management and pretty evenly spread between some original legacy new development properties and then acquisition properties that came into the portfolio in the last 5 years.
And Julie, remind me, how many states is Gardant in currently?
We are currently in 6 states, mainly the Midwest, and we are expanding into the Mid-Atlantic.
Well, Julie, keeping with you, if you don't mind, maybe just describe for the audience the current state from your perspective of affordable assisted living in the U.S. and why this segment is becoming increasingly important, not only for Gardant, but just for the population as a whole.
Well, affordable assisted living currently is really at this critical inflection point. The senior population is growing. It's growing rapidly, but millions of older adults simply cannot afford a traditional private pay assisted living community. Well, at the same time, nursing homes are far more expensive and often unnecessary. We've seen that through our advocacy efforts, and we've seen that through the different states, the six states in which we operate. And affordable assisted living really fills that gap by providing the dignity and support, the stability at a cost structure that works for families and works for the states that will invite a home and community-based Medicaid waiver program into their state. And as longevity of people increases, retirement savings lag, the affordable assisted living really becomes essential. It's not optional. It's an essential part to the future of senior care. And I've noticed that both with when we're talking to new developers or people wanting to get into the space, as well as if we're talking at a national level, like for an NCAL board, for example, and talking with other industry professionals.
And is it safe to say that, and maybe this is too simplistic, but when I look at affordable assisted living, I look at it as a really a win-win for both private sector, but also public sector, the resident, because at the end of the day, you have senior citizens who need some assistance with activities of daily living, but those residents or those seniors who cannot necessarily afford private pay assisted living. And so what happens, or what can happen, is you can have these senior citizens, maybe end up in a more institutional setting, like a skilled nursing facility on Medicaid. And while skilled nursing facilities obviously play a very important role in our senior living care ecosystem, they're designed for a certain type of population, and seniors would likely prefer to be in a more residential setting than a more institutional setting. And it goes without saying that the state, it's a lot more cost effective for the state to fund a Medicaid waiver resident at an assisted living facility compared to the daily cost of Medicaid at a skilled nursing. Is that fair, or is that too simplistic?
Simplistic is a good word. It confuses me why everybody can't get on board with it, especially when we're talking at people looking at a state budget, for example, and understanding the dynamics behind it. First of all, I'll say our skilled partners also understand, and they say they want somebody to live as long as they can in the lowest level of care that they possibly can. So our skilled partners are on board. They are our partners. We're all part of the continuum. There's this unique place right now that is kind of this middle market affordability place. And there's been research and people talking about this middle market, the forgotten middle market, this middle market gap. But if you could do something like Gardant's done and say, we can blend where a middle market, have a price point for the middle market where somebody is not spending down as quickly as they might would in maybe some higher private pay communities, which is also a place for them. There's a place for everybody here. They're not spending down as quickly. But if the transition to Medicaid happens, then you don't need to leave your home. You can stay in the same environment. You can have your longevity. You can have your wellness. You can have all of your friends, and everything's there. And because Gardant has chosen to really be purpose-built for the affordable assisted living, we have all the back office stuff that goes along with this, where a lot of providers don't. Because, Rod, and when he co-founded the company, saw that this was a need 25, 26 years ago. And we're seeing that now as we're going into different markets. So even though we're the largest affordable, we still have a private pay mix because we're serving both. We don't want somebody to have to leave.
Right. I'm glad you highlighted that most of your properties serve both populations, Medicaid as well as private pay. And highlighting that middle market emphasis. I know we all see each other, whether it's at NIC conferences or ACA NCAL and so many different conferences, but that does seem to be a focus and opportunity. And Rod, maybe I'll pivot sort of in that vein from an investor perspective. You've been involved with enough of these properties. When you look at the capital necessary to fund either new construction or acquisition and rehab, it's a little bit more nuanced because by nature of affordability, the margins are going to have some limitations. And so from an equity perspective, from a debt perspective, maybe talk about what do you think from your time in the industry makes affordable assisted living an attractive asset class for long-term investors compared to other senior housing product types?
Steve, the first point I think I would emphasize is that the demand or the market is so deep, compared to the upper 1/3 income of seniors, this affordable market, those that would qualify for Medicaid or soon would qualify for Medicaid after moving in and exhausting their own personal assets, that market may be triple or quadruple what the more upscale upper end markets would be. And pretty much virtually almost every market, be it rural, suburban, or urban, that affordable market's going to be so much deeper. And I think really since COVID, with cost escalation and interest rates, and I think you read any journal article, you can say, hey, the industry's maybe only been building 1/3 of what is going to be needed over the last 5 years. So I think that demand for both existing affordable properties and new properties is going to be so huge. I think the occupancy rates and turnaround and length of stay are all going to be positive items in the affordable industry.
Yeah, from a investor perspective and lender perspective, I mean, we look at the asset classes like you highlighted. You've got relatively high occupancy. You tend to have waiting lists. You have a lack of construction, but there's still enough, margin that's produced at the asset level that allows you to reinvest in the facility, expand, maybe buy other facilities, return a reasonable return to investors, and without a lot of the risks associated with some private pay, including that this is more of a need based. I mean, it's sort of toggles between need and want, but from an investor perspective, I think that's been appealing just for the consistency of returns when investing capital in this asset class.
Yeah, the only caveat I would add in there is, as you mentioned, margin. Yes, in certain states, it still is a state by state decision on what the reimbursement level is, what the reimbursement methodology is. And so, there's a good number of states where reimbursement levels are such where the margin makes it a good investment. There's a lot of states where it's very difficult or next to impossible to do it. And I think those are states that don't get a lot of involvement by developers and operators just because the reimbursement level is so low. But I think the other is the scalability. If you can take all income levels, including middle market and the lower income residents, then to build in a lot of markets 100 units up to 150 units, that you might not be able to scale that volume and have the efficiencies in development and the efficiencies in daily operations if you were just building for 100% market rate. So that's one of the other, I think, positive things that makes it very attractive for the investor is getting each property to that sweet spot of efficiency.
Yeah, well said. You have that diversity of sort of revenue stream, and if you're an investor, that feels good. You're not over reliant on one thing or the other. What else would you add, Julie?
To Rod's point, the states in which you choose to operate are really important. And this is where, from an operator standpoint and an investor standpoint, to combine advocacy efforts on each state. And I'll give you some examples. So there are some states within the U.S. that do not have a Medicaid waiver program for assisted living. There's some states that have, which is, we'll call home and community-based services, that assisted living will be with 14, 15 other programs that are trying to share this pot of money, and that's hard to manage. And then you have a couple of states, more than a couple, that have decided that we are going to have a separate waiver program for affordable assisted living, Illinois and Ohio being two of those. And when that happens, when you talk about the resilience for an investor or resilience for an operator, it also, in addition to consistency, there's also predictability there. And you don't have this risk of what happens when there's a change in administration or a change at a director of an agency, for example. What happens when there's a change, especially when you're sharing programs? So understanding what states you're going in, but also knowing that from when we look at an investor standpoint right now, because Rod had talked about the demand's huge. So if we don't come together and go into these states and say we have programs that work, look to other states that have something that's been sustainable over the past 25, 26 years, and we know is going to be sustainable going into the future. Let's take these programs and pull them into other states. Let's kind of remove these partisan barriers and say what's working here can work over here too. Rod has used a phrase many times that says it's really not about more Medicaid, it's smarter Medicaid. And there's research to prove that this is smarter Medicaid. And, Steve, and you know this because we pulled information together. We've come to states and we have a lot of respect for our state and U.S. representatives. They have a really hard job. It's our job then to provide them with a lot of data and a lot of real life stories so they can make informed decisions.
Well said. And I think both of you have done such a masterful job of not just being present in the advocacy scene, but taking a leadership role, whether it's on, ACA and Cal board roles, or even at the state level. In Illinois, the Affordable Assisted Living Coalition has been such an impressive organization that I think serves as a model, but also one that's collaborative. And if states want to learn, AALC's open to to helping them. Obviously, you two and Gardant leaders, the rest of Gardant leadership are. So there's very much a good public good that's kind of fueled, I feel like, by not only this product type, but by the way, in a very bipartisan way that you all approach it. And so we talked about, some, I guess, tailwinds and some headwinds, but as you know, and a lot of the ways in which we've all worked together, historically has been from a permanent financing perspective. And, the HUD 232 program has been around for a long time. And I remember it was about 20 years ago where Rod and me and a couple other folks went to DC, and HUD was starting to do some 232, 223F refinances of affordable assisted living in Illinois, supportive living facilities. And they loved the product type, right? Because it's meeting a need that's consistent with HUD's mission. You've got average occupancies, that tend to be in the mid to high 90%. You have debt service coverage ratios that are solid. It's sort of what's not to like. And so I know in Illinois, I think over half of the supportive living facilities are in the HUD portfolio from a financing perspective. Maybe Rod, talk a little bit about how HUD financing has been an important permanent debt option for Gardant, but just affordable assisted living in general.
Yeah, I think one of the first and foremost positive things on the HUD loans are, the non-recourse, status of it. I think allows developers, a good sense of comfort and helps create volume. I think HUD financing is just, rock solid, reliable financing, and it's can be repeatable, scalable. I think a developer that might be, a short-term hold to develop and resell, maybe it's not the right recipe. But I think especially for long-term hold, it is just a rock solid partner with the developer and the operator. And I think in our company, we just made the decision that to be able to piece together creative financing, we're going to have that patience and have the back office to go through whatever bureaucracy there is involved in creative equity or in HUD type of financing. And, you can just rely on it and repeat the development. And I think the various syndicators and HUD originators and consultants that we've worked with, once you have proven that this works and risk mitigation is there, and nobody can debate that the residents, the end users are just so deserving of being residents, and the communities do so well when you look at them from the investment side of things, and they do so well on the human side of things. As you mentioned earlier, Steve, it's kind of win-win-win all the way around.
Yeah, that's well articulated about HUD financing, and you also mentioned syndicators, and some of our audience might not be familiar because that's bringing the affordability from a tax credit equity perspective into it. And I've always thought that Gardant's business model of understanding tax credits, because some of these necessitate tax credits and 4% bond financing to effectuate a property development due to the restrictions of affordability. Other times, tax credits are not necessary. It just depends on the market, the overall basis of the project. And so to be able to wear that tax credit hat, but also be able to secure more traditional private capital as your equity source. But good news is on the HUD front, it can work with both. And at the end of the day, it understands how to work with both. Before we get into the final question, I always like to ask about maybe your favorite podcast or book. Maybe paint a picture, and we'll start with Julie. What does the next 3 or 5 years look like for Gardant?
We talk about the next 3 to 5 years a lot. And if we look at the last 3 years or the last 25 years, there's three pillars that we base things on. We look at people, purpose, and goals. And so we came out of this 3 years and kind of said, hey, how did we do with our people, purpose, and goals? And we exceeded what we had hoped to do. And so our next strategic 3 years is based on people, purpose, and goals. And the people piece is big. It's because, first of all, who are we serving and who's serving the people that we're serving? And how well are we developing others? Well are we meeting the needs? How well are we understanding what the needs of the next cohort are going to be? People talk about baby boomers. Well, there's such a wide range of what the needs are between what you're building today and investing in today and what it's going to be from 10 years from now. So we continually plan on the people piece. And then we're aligned around our purpose and say, what does the purpose look for us? And, the next 3 to 5 years, we want to be serving 24,000 people because we know the demand is there. We also know that we are uniquely suited to meet the demands with the people we have on board and the people that we're developing, the people that are coming into our organization. And the way that we are built within our mission, we're uniquely suited to serve, we can serve 24,000 people. And then we say the next, 3 to 5 years. And we need others to do the same thing because there's going to be a lot more than 24,000 people that need to be served in the next 3 to 5 years. And so that is our purpose. And that's also what our goals look like. So Steve, I would say that's what it is for Gardant. So we continue to resource what we need in order to meet that. And it's all in service of people.
That was a really good answer. And that was not a scripted question. That was off the cuff. And I can tell Rod feels just relieved that you took that question because you just nailed it.
Yeah.
Anything you'd add, Rod?
Maybe the only thing I would add is, the boomer generation, which we've mentioned before. I think that congregate living, assisted living, the boomer generation who's changed a lot of things about our society, being at Woodstock, protesting wars, women's rights. I think the boomer generation, the majority, is appreciative of how they've changed our world and our norms. And so congregate living, the fact of living with your peers, making new friends, that's still going to, I think, excite them. But they are going to be a more educated, more demanding end user of our services. And I think they'll want to be involved and engaged right up to their very last day. So I think assisted living and Gardant, we have to continue to evolve with them to make sure that end user still looks upon assisted living as it's very acceptable, and they can rely on the healthcare services, the personal care services that are baked into it, but it just shouldn't feel like an institution, and they should have a say-so, be very involved in their lifestyle experience right up to the very last day. And so I think that Gardant is committed to that. It does take, I think, a little bit of growth and evolvement on how we market and how we frame that lifestyle, and that it is not an institutional flavor.
All right, Julie, what's that one podcast or book or something else you might share with the audience that's been meaningful to you?
There's many. I will say I just recently purchased 5 Stephen Covey books on the speed of trust. It's and this is something else that I would encourage others to do. As an executive leadership team, we coach together. We have a professional coach that we coach with to have these kind of conversations and make sure that we're aligned with our people, purpose, and goals. And anytime there's a shift, you can have a great 3 years, and then you have this vision for the next 3 years, and it's like, wait a minute, it feels a little different. And trust can wane. It can shift a little bit, which is not a bad thing. It just tells you that you're human and you're willing to discuss it openly. So we're rereading The Speed of Trust. I went and bought 5 books for our executive leadership team, and it's something I've read 3 times before. He wrote it a long time ago, and it's still as relevant today.
Rod, what say you?
I have to credit my wife with a book that's in the house that she grabbed a couple months ago called The Psychology of Money. I can't quote you the author, but tagged on and began reading it and listening to the audio version of it. And the difference between being rich and being wealthy. regardless of how much money you might create, how are you using it? Are you using it to really live out the lifestyle that suits you? And so that's the wealthy part. How are you using dollars to create the life that you wanted? And an example of a guy that was, I think, working in accounting and finance, but he really wanted to be a musician. And 20 years ago, when he first got his $20,000, that's all he needed to, kind of create the nest egg, and became a musician, and said, I never worked another day in my life. And it was only $20,000, but for him, he used that wealth to create the lifestyle he wanted. And so I think there's a lot of good perspective in the book, personally and professionally.
Well, Julie and Rod, thanks so much for taking some of your valuable time to be with me on this latest edition of the VERSED podcast. And for audience, thanks for tuning in. We'll have more exciting, informative, and engaging conversations coming up in 2026. So thanks again, and Happy New Year.
Thanks for tuning into VERSED, powered by VIUM Capital. The conversation doesn't stop here. Let us know what topics you want to hear, and let's make an impact in healthcare and seniors housing together. Until next time, I'm your host, Steve Kennedy, and this is VERSED.